Craig, if I start with you, what do you think has been moving the market of late? Is it just technicals, or is there some way to come to a PE multiple, even though we don't have that clear guidance?
At Icon, we're value investors, and we find the market to be extremely attractive right now. We've been fully invested during this rebound, and we would expect stocks to be priced higher a year from now.
But if you're a value investor, what valuation are you keying off if you can't be sure what the E part of the PE multiple is?
We never use PE or price to book. We build off an equation Benjamin Graham published last century. We've modified it. So we compute intrinsic value for companies, and we're finding the market now to be priced 30 to 40% below fair value.
Bryce, where do you stand on this debate? Are you finding it difficult to value companies?
Oh, it's very difficult without any guidance to really know what companies are worth and both their stocks and their bonds. As a bond investor, we're seeing a ton of debt being raised in the corporate bond market. And the way people are valuing a lot of these companies is how long can they survive? What is their cash burn? How much do they have? How much cash do they have on hand? If they're able to raise $1 billion, and let's say they're an airline with a $50 million a day cash burn, okay, they just bought themselves an extra 200 days to survive. And that's step one. Step two is you need to see some sort of slowing in the spread of the virus. Once you do that, you'll see analysts start to use 2021 earnings expectation for trying to value stocks. But that'll provide some lift somewhere down the road, 2-3 months down the road. Right now, what's really bizarre as a bond investor is seeing that companies' bonds do better as they are borrowing more and more debt. It's supposed to be the other way around. But what's happening is that the more capital that are able to raise in the stock and the bond market, it means the longer the company can survive until things rebound. So it's a little bit strange to be valuing companies on their survivability right now.
Craig, is your optimism on the stock market based on economic reopenings going smoothly and happening soon, or is that not even necessary for you to be optimistic about these valuations?
Well, first, at the bottom in late March, we had all the behaviors and conditions typical of bottoms. And historically, the stock market has led the economy by 6 to 9 months. So all the bad news was priced in late March, and now the market is just telling us they expect a rebound by the fourth quarter of this year.
And so tell us some of the things you're most attracted to at the moment, Craig.
Well, we like the economically sensitive sectors, consumer discretionary, information technology, industrials. Those that are some in materials also. Those that are sensitive to the economy.
Bryce, where do you stand on the technicals? I get your point on strength of balance sheets. What about the technicals in the short term?
Well, on the bond side, we like anything with credit. We even like municipal bonds a great deal, both taxable and tax-exempt municipal bonds. There are plenty of minefields, though, out there with senior housing having some issues. The Treasury, Mnuchin coming out and saying, hey, we're going to borrow $3 trillion. I don't know how that's going to weigh on the stock technicals or the bond technicals right now, but it doesn't seem like a good thing. What we also need to do is to see some sort of guidance from the Fed saying, okay, how many of that $3 trillion in debt are we going to buy? How much are they going to absorb in that? And that will affect both stock and bond valuations in a way that I don't think everyone's factoring in right now. If they come out in a big way and they soak up a lot of that debt, a lot of it's going to be in T-bills, $2.6 trillion. It's going to be issued in T-bills. If the Fed comes out and vacuums all those up, I think stocks and bonds could do quite well. If they don't, that's going to be a huge pile of debt for the investors to try and swallow.
Bryce, Craig, thank you both very much for joining us.